Hello, and thank you for joining us for today's webinar, 2015 Tax Update for Nonprofit Organizations. If you're attending the webinar to receive California CE credit, please note that if you meet the requirements, which I'll go over in a moment, that you'll receive an email within 3 business days to access your certificate of completion. So I'd like to go through a couple of housewarming items before we get started. You can maximize or minimize the webinar pane during the presentation by using the red arrow buttons. During the webinar, we also encourage you to ask questions. You'll see in the webinar pane, there's a chat box that you can use to type in your questions. Just type them in and click submit. Our presenters will do their best to answer the questions during the webinar or at the Q&A session at the end. If by chance we don't get to them, we will definitely follow up with you after the presentation. Second, to ensure good audio quality, please check your settings to ensure the appropriate audio option is selected. If you're using a telephone, please click on the Use Telephone Audio mode. If you're listening through the computer, then please click on the Use Mic and Speakers option. Now I'd like to present a quick review of California CE requirements. To qualify for California CE, you must be using a personal computer, no PDAs, and log in with your own information and unique URL. You must be logged in to the online software for at least 50 consecutive minutes within the scheduled time frame. You must actively respond to at least 75% of the polling questions. There will be 4, which means you need to answer 3, and you must complete the evaluation survey at the end of the webinar. And now I'd like to introduce our presenters. Lynn Henley is a tax partner and head of Armanino's nonprofit tax practice. She's been providing consulting and compliance services for more than 18 years to a variety of tax-exempt organizations, including public charities, foundations, supporting organizations, social welfare orgs, labor unions, social clubs, and business leagues. She has a master's degree in taxation from San Francisco State and belongs to the American Institute of CPAs and California Society of CPAs. Our second presenter is John Panetta. He's a director with Armanino's nonprofit tax practice and has more than 30 years of experience providing tax-exempt organizations with a wide variety of tax, business, and consulting services. Prior to joining Armanino, John worked with BPM, PwC, KPMG. He also served with the exempt organizations branch of the IRS National Office. A frequent lecturer, he has served as an adjunct faculty member of the School of Taxation at Golden Gate University and as a visiting lecturer at the Graduate School of Business at Stanford University. And quickly, I'll go over our learning objectives for today. We're planning to evaluate recent IRS action on delinquent payroll taxes. We'll identify the controversial short form 1023EZ application for exempt status. We'll review the charitable contribution substantiation required by the IRS. We'll discuss the report of foreign bank and financial accounts, and we'll review Form 990 changes and other tax-exempt updates. And with that, I will turn it over to John.
Good day to everyone, and thank you for joining us. For all the Northern California folks, 2 key words for today are Go Warriors. Now that that's off my chest, I'd like to talk about a report that was issued recently by the U.S. Department of Treasury regarding delinquent payroll taxes, and it starts on slide 10 of the presentation. This report came out last August 2014, U.S. Treasury Inspector General, and it indicates the compliance or lack thereof with respect to tax-exempt organizations and collection and payment of employment taxes. You can see the numbers are rather staggering, over 64,000 tax-exempt organizations with almost $900 million of unpaid employment taxes. Now, these are statistics based on records as of mid-June 2012, so they're clearly 3 years old, but nonetheless pretty staggering. Of those 64,000, about 1,200 owed about $100,000 or more each, and 9 tax-exempt organizations had 10 or more years of unpaid taxes totaling $5.5 million. So pretty staggering amounts. And the reason we thought it important is because we know that for tax-exempt charitable organizations, the use of assets is clearly important. Following the rules is clearly important to preserve tax-exempt status as a good citizen. So this level of non-compliance is rather remarkable. You know, the U.S. Department of Treasury folks walked across the street to IRS in Washington and said, "Did you folks know about all this?" And of course, the exempt organizations folks said, "Why would we know about this? That's the responsibility collection of payroll taxes of the Small Business and Self-Employed Division. So no, we don't know at all about this. And then Treasury said, well, let's fix this problem. What we'd like you to do is really talk to each other. So we're going to ask the small business folks and self-employed division to send you collection information on payroll taxes for tax-exempt organizations. Then we want you and the tax-exempt organization division to analyze this information and provide us that information to determine whether we have a potentially abusive situation. And then to the extent that you've gone through several iterations of analytics, we at Treasury would like you at IRS exempt organizations to tell us whether you would like a legislative proposal to strengthen the IRS's ability to enforce payroll tax noncompliance. Now, it's the last item. The first two items are clearly what we expect of our government. No one talks to each other unless pushed and pulled. That seems to be the status quo. But it's the last item, the notion that, gee, there might be more legislation at least addressed by the U.S. Treasury and submitted to Congress to provide more emphasis on the collection and payment activities of tax-exempt organizations with respect to payroll taxes. So certainly something to keep your eyes on. The second thought that we wanted to bring to your attention is deals with the short form 1023. This came out by the Internal Revenue Service in 2014 at a time when IRS had spent 2 or 3 years chasing after very small organizations under $50,000 in annual revenues, and also had put in process a whole lot of process to have the under $50,000 type organizations who had not filed in a long time revoke their status and asked to indeed file their past tax returns where required. So their focus was on small organizations, and one of the bright ideas was, why don't we put a very short form application for tax exemption together for organizations that expect $50,000 or less in annual revenues and would have assets below the $250,000 level. So they unveiled this 2.5-page form. To the extent people have not looked at this, and why would you, but to the extent you haven't, it really is pretty remarkable. It asks for name, address, and phone number, who's on your board, whether you're a corporation or a trust, and check a box as to whether you're focused on literary or health or education or general charitable activities, and then asks whether you're aiming for public charity status or private foundation status. That's it. You sign it and you send it. And some folks that have looked at this have said, geez, that's pretty bare bones when you get right down to it. With the bigger 26-page application, you get IRS gets all into conflict of interest and what's our mission and what's our purpose, and tell us more about governance and administration. We just wonder if this isn't an avenue to allow some people to commit fraud by setting up charities for something other than charitable purposes. They also indicated that, gee, is IRS walking away from abuse with respect to charities and affecting public trust. Obviously, an overarching concern with legal and operational footfalls as to whether we're doing the right thing here. And another comment that was clearly heard was, gee, these small organizations also have an obligation perhaps with their state attorneys general's office, and also with their state revenue department, and now the states are going to be burdened by a lot of these small organizations coming through as well. The IRS response to that was, look, we took a long time to assess the risks involved in this short form, and we have received, at the time this report came out, about 28,000 short form applications, and we took time and selected 1,000 for more in-depth review, asked more questions back and forth and we found no indication of intentional misuse. And then probably the telltale signal as to why all this happened when the IRS commissioner stated, at the IRS, we have funding levels that go back to 1998, 17, 18 years ago. And during that time, we've added 30 million additional tax filers of all types, both commercial and tax exempt. So you get a sense that IRS is trying to cope with its own playpen, the size of a playpen it has to work within. The resource constraints are severe. There's also additional information that was published recently about the probability of audits being reduced for all filers, except the very wealthy. And again, it indicates just an ordering of IRS priorities to reflect their own resource constraints. But clearly, there is focus on the short form 1023 to the point where we may see a bit more substance added to it. Certainly, the conflict of interest would be one, and a mission statement might be a second that could come into play. We have a polling question that Debbie will take us through.
Thanks, John. So as a reminder, to receive CE credit, you'll need to answer 3 of the 4 polling questions we'll be asking today. And the first is just a quick review of what John has just gone over. True or false, the short form 1023 will be available to a charity with assets totaling more than $250,000. And again, the answers are A, true, B, false, and C, not sure. I'll give you about 10 more seconds to answer. And we'll close the polls in 3, 2, and 1.
Well, thankfully, about 70% of the folks got it right. It's only available for those organizations that anticipate $50,000 or less in annual revenue and have an asset base of less than $250,000. So the correct answer is false. Now, the next topic that I wanted to address is something that we see on a constant basis as an issue of litigation between taxpayers and the Internal Revenue Service. It is constant, and the other thing that is constant is the consistent position of the judicial body that hears the case and dealing with charitable contributions and substantiation. I think you may remember that the case that came out most recently is one that sort of tugs at you a little bit. The individual family contributed a whole mess of things to a variety of charities in their community, as you see books, furniture, jewelry, toys, clothes. They claimed $37,000, just over that, in charitable deductions. The IRS denied it, they litigated it, and ultimately, as you see in the bottom bullet point, the family was denied the charitable contribution deduction for everything, since the individual here didn't show any evidence of substantiation or acknowledgments. It's a pretty tough case to read, because it's clear that the court said, we know you gave these things to a charity. We know that. But you didn't follow the rules on substantiation and acknowledgement, so we cannot allow you to take an income tax charitable deduction. Now, as we know, most of us are very familiar with the notion that at $250 or more, the taxpayer has to receive a, quote, contemporaneous acknowledgement, a letter, which basically says, hey, here's what you gave us, and whether or not the organization gave anything back by way of goods or services, and if it did, a description of the services. Now, one thing to keep in mind here is when the word contemporaneous is used, it means that that acknowledgement or letter went to the donor on or before the due date of a tax return for the year of contribution. So if I made a gift of $300 to a charity in 2014, that letter should be in my hands certainly by April 15th of 2015. I would think that would stop there, because the organization wouldn't have any clue whether I'm on extension or not. So pressing the issue beyond that with the expectation that I am on extension to issue a letter thereafter seems a little bit problematical. So my sense is that April 15th is probably, of the year following the year of gift, is probably the right timing. Now, it may be worthwhile to just remember that we have rules where we have non-cash contributions of more than $500. The taxpayer needs records. So in dealing with your donor groups, you should be sensitive, I would think, to these rules, records that show how the donor originally acquired and when the property that was donated, a bit of a description of the property and its cost or basis to the donor, and a fair market value of the property when it was contributed, and how we determine fair market value. Standard fare, the onus is clearly on the donor to come up with these bits of information to support a income tax deduction on their personal return, but clearly something that we may wish to at least be sensitive to as we're talking to our donor community. When we get to non-cash contributions of more than $5,000, we not only have all the things that we just talked about, which are in the first bullet point, but you may remember again that for gifts of property of over $5,000, the individual must obtain a qualified appraisal of the items and attach the appraisal to his or her tax return. The word qualified always means that there are definitions about what a good appraisal is. So someone skilled, someone with a bit of experience in this area, who can certainly take on the valuation of a collection of jewelry, a collection of automobiles, real estate, whatever it may be. That is something that the IRS also focuses on, not just the fact that the appraisal is there, but that it was done by someone who's competent in the field, and of course that item be attached to the tax return. Now, there is some pending legislation here that may be of interest to some of us. Certainly Congress has a lot on its plate that it's trying to address, and we read about the Trans-Pacific partnerships and what's going on overseas a lot, as well as the push and pull over immigration and the like. But one of the things that's out there is a legislation called America Gives More to extend 3 provisions that expired dealing with charitable giving, affecting contributions of food inventories, contributions of conservation easements, and to restore the direct IRA rollover. All those provisions expired at the end of last year, and there's a movement afoot to reinstate those for 2015 donors. Also, there is another one that has been discussed for probably 10, 12 years that I can recall, and that is to give the foundations a bit of a reprieve on calculating their excise tax on investment earnings, which right now vary between 1% and 2%, dependent on the level of giving over a 5-year history. And there's a convoluted calculation that private foundations must do in order to see whether they qualified for the reduced tax or not. Congress has talked for a long time now about trying to get one rate and skip all the convoluted sausage grinding calculations. And so what's in the America Gives More Act is to set the private foundation excise tax at 1% of net investment income as the final place that foundations would be with respect to their excise tax liability. You know, it's June, and one of the things that we focus on right after April 15th, believe it or not, is not only the May 15th deadline, but also the requirement for organizations and individuals to file reports for foreign bank and financial accounts that they may be involved with. Just as a bit of an overview, the foreign bank rules, FBAR, apply to a U.S. person who has a financial interest in, signature, or other authority over a foreign financial account, where at any time during a calendar year that account has a value of more than $10,000. So generally speaking, U.S. person includes tax-exempt organizations. Many of us are familiar with this. And bank accounts, financial accounts includes, as you see on the list here, the classic bank account. It can also include brokerage accounts held overseas or insurance accounts and some foreign mutual funds as well. Generally speaking, private equity funds are excluded, and there's definitions that can be had to flesh out exactly what type of accounts are reportable here. So U.S. persons over $10,000 in a foreign account somewhere, we need to file a form by the end of June. There's an increased focus in this area, principally because there's the penalties have increased, and we'll talk about those over time. And so the IRS clearly is interested in compliance. There is IRS enforcement efforts, as we know from the popular press, looking to have people fess up on unreported earnings from offshore accounts, both at the individual level, and we read enough about it at the corporate level, and repatriation of foreign earnings. And also the third piece is there's a bit more cooperation among global tax authorities, among developed and developing countries, to try to corral the issue of offshore reporting of income for all their interests and all their purposes. Deb, we have another polling question.
We do. Thank you, John. As a reminder, this is the second of 4 polling questions, 3 of which you'll need to answer for CE credit. The question is, or the statement is, FBAR reporting is not generally required for which of the following? Is it A, bank accounts, B, private equity funds, C, insurance accounts with cash value, D, mutual fund accounts, or E, you're not sure? And as a reminder, while you guys are answering the question, feel free to put or type in any questions that you might have. We'll be able to answer them during the webinar. And I'll also be sending around these slides after the webinar as well. So if you've got questions or are trying to take notes frantically, don't worry. We'll be sending them around for you to review. So get your answers in. We'll close the polls here in 3, 2, and 1.
The correct answer is that these FBAR requirements do not attach to private equity funds. A lot of our folks got that right. One aspect of the FBAR filing that is now mandatory is the fact that we have to e-file it. No paper filings of this form. It is due in the hands of the U.S. Treasury Department, not IRS, in the hands of the U.S. Treasury Department by June 30th each year for the prior year. This is something that was tried on an optional basis last year. It's mandatory now, and there are absolutely no extensions. It's a drop-dead date, a hard date. After there is an e-filing of the FBAR form, confirmation page comes up online, and an additional email is sent to the individual who filed it to indicate that the information has been received. One thing that was requested by the practitioner community and that the Treasury Department does now have is the ability to allow your CPA or lawyer or other advisor to file this form on behalf of the organization. That involves a bit of a form between the two parties, let's say the CPA and the organization, authorizing, kind of like a power of attorney, authorizing the CPA to do this filing, and that's a Form 114A. The main form that we file with the Treasury Department is Form 114. Now, sometimes we involve ourselves in an oopsie. We miss, we forget. It's a little bit late. The rules here say, look, if the failure to file was inadvertent and it just happened, then so long as the individual or the organization reported all income from their foreign financial accounts on tax returns and tax was paid as applicable on those amounts, we're not going to penalize you. So that's kind of a nice thing to do. So reporting the income on the Form 990 or 990T as applicable, paying the tax, again, if applicable, basically absolves us from penalty concerns. And the person also can't be under an IRS exam. They need to do this step up voluntarily in advance, and haven't heard from the IRS or in an exam situation. And the delinquent FBARs also have to be e-filed, and they're generally 6 years where the lack of an FBAR filing are viewed as delinquent. 6-year statute of limitation is involved. So at any time within those 6 years, you can file for a delinquent FBAR. Now, the penalties are severe, and they range from $500 to $10,000 per account per year. There's also a much more onerous penalty where the failure to file was not inadvertent, but rather willful. Just didn't care to file it. Thank you very much. And here the IRS came out yesterday with a brand new position. Take the situation where the organization has a foreign account, and in years 11, 12, and 13, the account had 50,000, 100,000, and 200,000 as the highest amount for the year. If the failure to file was willful, then what the rules once said is we get up to 50% of what was in there as a penalty. So 50% of 50, 25, plus 50% of 100, 50 is now 75, plus 50% of 200 is now 100. So we're up to $175,000 when the account probably has no more than $200,000 in there. So that was a bit draconian. The practitioner community commented, and IRS basically says, okay, in the case of a willful failure to file, then you know what we'll do? We'll take the highest outstanding amount and assess a penalty on that. So it's $100,000 max, based on the $200,000, the greater account balance, and then we'll allocate it to the various years based on the ratio that each year's account balance held to the total for 3 years. So that's a slight change. The whole point of it is not to understand the mechanics, but to understand that there are very, very serious penalties involved for failure to file an FBAR. Yeah, thank you very much for listening in. Hopefully I kept you awake for most of this time.
Thanks, John. That was terrific. I learned a lot this morning. Thank you. So now we're going to move on to some Form 990 changes. So these are very, very compliance-oriented changes. In all of the IRS forms in the instructions, you will see a section that's entitled What's New. So for instance, if you go to the Form 990 instructions, you'll see the 3 items listed on your slide. Now the text on the slide is abbreviated, but the information is the same. The first item there addresses the treatment of reportable compensation paid within 2.5 months of the relevant calendar year. So this is mostly seen in a for-profit context, and it has to do with when the entity takes the deduction. But for some reason now they've added it to the exempt world. So for purposes of Part 7, and that's where you list, your officers, directors, trustees, key employees, and the 5 highly compensated persons. For purposes of Part 7, amounts paid within 2.5 months after the year end should not be treated as deferred. So in other words, that's going to go in current, and we're not going to show it in what is essentially the retirement plan column. So that's a little different. It's not going to apply to a lot of people, but in case it does, now we have some guidance. The Part 11 change is just a change in the instructions, but there doesn't seem to be any change to how we've been completing the form. It's still, those unrealized gains, other changes. So I think it's just an instruction clarification. And then finally, there's a change affecting organizations that file group returns. So if you're in that category, please do take a look at that change. There have been more significant changes to Schedule A. Schedule A is the public support test. Now, if you are a supporting organization or a supported organization, you will have some more work to do. So there's more work for the supporting organization because it has to fill out, there's quite a few questions and additional pages in the Schedule A. The supported organization may have to do some work because they'll have to supply information to the supporting organization, but the onus will be on the supporting organization. One clarification that they have offered for the public support test is if you can sort of envision page 1 of the Schedule A, there's a number of boxes there, and the organization checks the box that corresponds to the reason why it is not a private foundation. Those boxes have generally, in the minds of practitioners and organizations, corresponded to a particular part of the public support test. So if you go to parts 2 and part 3 of the Schedule A, those are separate ways of computing your public support percentage. So again, in the minds of practitioners and many organizations, if you checked box 7, you would fill out the first public support test. If you checked box 9, you would fill out the second public support test. And what the instructions are now saying is that even if you check a box other than box 7, you could still do the second public support test if that came out better for you. So just a little clarification there. Above the What's New section of the instructions for all the forms is a Future Developments section. And what is very handy is that if you are on the IRS website and you go to that Future Development section, you'll see a link there. And it will take you to a page where the IRS has put 4 different categories there for our reading pleasure. The first being current products, so you can look at the current forms. And then what's right below that are changes to whatever form it is. And so in our case, it would be changes to Form 990. Now, why that section is very handy is that the forms themselves and the instructions that come out are published at some point. And after that publication date, even if there are changes, they don't appear in the form because the form is, quote unquote, set in stone. So if you go to this changes to Form 990 section, you will see changes that have been made after the forms and instructions were published so that you are very up to date if you check out those changes. They also have a category for other items, and then they have a place for us to comment on Form 990. So feel free to comment early and often. This next topic is one that continues to be a challenge. With regard to service provider classification, the IRS has revised its 20-factor test. Now, control and independence are still the central elements of the analysis, but they've tweaked their test a little bit. Now, the facts that provide evidence of the degree of control and independence fall into 3 categories: behavioral, financial, type of relationship. So behavioral, it's like, does the company control or have the right to control what the worker does and how the worker does his or her job? The financial considerations are the business aspects of the worker's job controlled by the payer. Things like this include how does the worker get paid, whether expenses are reimbursed, who provides the tools, supplies, etc. And then type of relationship. Are there written contracts or are there employee-type benefits? So you can see that under a contract, that makes you look more like you're independent, but if you get employee-type benefits, that makes you look more like an employee. So type of relationship is a big part of the analysis. Businesses must weigh all of these factors when determining whether a worker is an employee or independent contractors. And as we discussed when we were looking at, the relationship between the service provider and the entity receiving the services, Some factors will indicate the worker is an employee, while other factors will indicate the worker is an independent contractor. There is no magic. There's no set number of factors that makes a worker fall in one category or the other, and no one factor stands alone. So you have to look at the entire relationship and consider the degrees and the extent of the rights. So if you are working with someone or at a cocktail party having this discussion, and somebody says, oh, because of X, this person has to be an independent contractor or this person has to be an employee, just bear in mind that this is a complex analysis and no one factor is going to put you in one category or the other. Now, one of the things that the IRS has offered to us is that they will do the analysis for us and then tell us what they think. So there's a form SS8 that you can submit to the service with all the information, and they will write back to you and indicate to you what their opinion is with regard to worker classification. Now, this can take up to 6 months, but if you are going to be hiring employees that are under a similar model on a consistent basis, it might be a good idea to submit this request to them and see what you get back. Which brings us to polling question number 3. Debbie?
Thank you, Lynn.
Okay.
This is our third polling question, so again, I feel like I'm a broken record, but you must answer 3 of the 4 polling questions for CE. The question is, facts that provide evidence of independence of contractors fall into which of the following categories? Behavioral, A, financial, B, types of relationships, C, all of the above, D, or E, you're not sure. And for those of you that were just listening to Lynn, she had a link up on the screen. We've posted that in the chat box for you if you want to take a second and click through. If not, as I mentioned, I'll be sending the slides around after the presentation, so you'll have that link available to you. We'll close the polls here in 3, 2, and 1. And it looks like 94% of you said D, all of the above. Lynn?
This is a great group. I can tell we're having a good group logged on this morning. So thank you all for participating in that polling question. So let's begin this next segment with a quick refresher. This is not necessarily an update. It's more that over the last, I would say, 18 months, this topic has come up so much. And I think there's so much confusion out there about it that it seemed like it would be appropriate to include today. So, basic refresher. Organizations qualify for tax-exempt status under 501c3 by virtue of the fact that they serve charitable, educational, religious, scientific, etc., recognized charitable purposes. However, an otherwise tax-exempt organization is nevertheless taxable on income earned from its regularly carried on business activities that are not substantially related to its exempt purpose. Okay, that's the basic UBI. Not related, trade or business, regularly carried on. Okay, so that's the basis of our conversation. So what we're talking about in this next segment is what happens when a tax-exempt organization performs services for another tax-exempt organization. And Michelle, you can go to the next slide. Thank you. When one organization provides services to another organization for a fee, the analysis of whether income from the services provided is subject to tax generally boils down to a question of whether the services are or are not related to accomplishing the organization's exempt purpose. The tax law defines related in a very technical way, and this is where the analysis can get very tricky. A regularly carried on business activity is related and therefore not subject to tax if the activity contributes importantly to the accomplishment of the organization's exempt purpose. So let me repeat that. A regularly carried on business activity is related if the activity contributes importantly to the accomplishment of the organization's exempt purpose. In other words, the business activity must have a substantial causal connection with the achievement of an organization's exempt purpose. Michelle, you can go to the next slide. When you're performing your analysis of whether the services you're providing are going to be considered UBI or not, there are two separate standards to consider. There's Section 501c3 standard and the Section 513 standard. The problem is the two standards are often erroneously merged during the analysis. And what we want to, I think, if anything, come away with this discussion today is that 501c3 and 513 are separate, and they do not have to be combined during this analysis, and we'll get into the detail of that. So what happens is when you're working with service providers or trying to do this analysis, many times people will apply this higher 501c3 standard for exemption to evaluate the service agreements. So that, and what happens is payments from one organization to the other then begin to appear like UBI when they're really not, because the appropriate standard should have been the standard in Section 513. Now, so as we did in our little basic refresher, to qualify for 501c3 status, an organization must engage primarily in tax-exempt activities, charitable, educational, religious, scientific, etc. So it says in 501c3, definitely charitable, educational, religious, scientific. The organization's primary activities must directly further its tax-exempt purposes, and to do that, the activity itself must be charitable. Okay, so we have the organization, it's doing an activity, its main activity over here, and let's say some large percentage of its activities are performing its exempt purpose. Then on the side, we have this other revenue stream that we've created, and we're trying to figure out, is that UBI? So to do that analysis, to see if our regularly carried on trade or business is related and therefore not subject to UBI, this side activity need only bear a substantial causal relationship to accomplishing our tax-exempt purpose. The activity itself does not need to be charitable to qualify as related. The only thing it has to do is indirectly further the organization's tax-exempt purpose. Okay, we're looking for that substantial causal connection. So you can see that if someone began to apply the 501c3 standard, which is asking the activity itself to be charitable, if you're doing a side activity like, say, admin services, right? You're like, well, admin services in and of themselves are not charitable. Then you'd say, oh, well, that must be UBI. Well, that analysis would not be correct because you're applying the 501c3 standard when you really should be applying the 513 standard, which is just, does this support my exempt purpose? So let's look at these standards in detail one at a time. So Section 501c3 requires that an organization must engage primarily in, and that word should be charitable. So charitable, educational, scientific, testing for public safety, etc. purposes and activities. Its primary activities, right, our major activity that we spend our days doing must further the tax-exempt purpose of the organizations, and the activities themselves must be charitable. Okay, that's 501c3. But then when we go to 513, the activity need only be related. It needs to bear a substantial causal relationship to accomplishing the tax-exempt purpose. It does not have to be charitable. So I know I'm being a bit redundant on this, but it's an important distinction. And Part of what you'll recognize when you start analyzing these activities and you're thinking, okay, what if we provide this service to X organization, or what if we provide it to Y organization? What you'll begin to see as a pattern is, in general, the more similar the two organizations' purposes are, the more likely the services will qualify as related. So if you do the same thing as some other organization and you are performing a service that they would perform anyway as part of their exempt activity, there's a high likelihood that it's not going to be UBI to you. So that's just something to bear in mind. Following this webinar, you'll receive an email with 3 attachments. There will be a general counsel memorandum and 2 private letter rulings. I'm providing these so that you will have a way to begin to understand this complex area. So if this area is relevant to your organization and you want to dig in, these 3 documents will provide a good start. Now, private letter rulings, as you know, may only be relied upon by the taxpayer who requested it or them. Despite this limitation, however, private letter rulings do provide an indication of the IRS thinking on the topic. So let's begin with General Counsel Memorandum 39715. In this GCM, there was a performing arts organization, and that's sort of, they referred to it in the memorandum as a performing arts organization. What it was sort of a centralized facility in the community where performing arts activities took place. In the GCM, that organization was found to accomplish its mission both by putting on its own theatrical productions and by leasing its facilities to other people who were producing productions. But in doing so, it would provide services to those other performing arts organizations. For instance, the services included box office personnel, doormen, ushers, ticket takers, supervisors, security guards, and stage crew, teamsters, wardrobe personnel. So this organization was very intimately involved with other people's productions. And so that took them out of the rental category. Income from rent that isn't debt financed is normally excluded from unrelated business income, but since these folks were providing so many services, it took them out of the rental category, and they couldn't qualify under that exception. So they had to qualify as not UBI by virtue of being related. In that ruling, among other things, the service stated, they said, we have found no appropriate basis for distinguishing between the organization's own productions and those of the third-party lessees. Both activities are designed to promote the performing arts in the community. Also within the ruling, you'll see there on the slide, that the IRS observed that the commercial nature of the services provided was not relevant to the analysis. Commercial type services do not need to be provided at a discount. The only question was, do the services bear a substantial causal connection to accomplishing the organization's exempt purpose? Now, you're probably saying to yourself that you have heard that having a commercial operation is a problem, that it will throw you into UBI, or that you can't charge market rates for your services. Neither of those things on their own give you an answer in either direction. They are merely factors and part of a larger analysis. So this is a very good GCM because it addresses a lot of issues and gives you lots of good references. Which brings us to polling question number 4.
Thanks, Lynn. And we're going to jump back a second here. So this is the 4th and final polling question. So again, if you've missed one for CE, please do make sure you answer this one. So Section 501c3 states that an organization must engage exclusively in specific types of charitable activities. Is this statement true, A, B, false, or C, you're not sure? Get those answers in. And we'll close this poll here in 3, 2, and 1. And it looks like, Lynn, about 57% said true, 40% false.
Thanks, Debbie. Now, where this question becomes so important is that the service has kind of pulled a little bit of a trick on us. I guess it's the Treasury Department, actually, that writes the code and the regs. Section 501c3 actually reads that an organization must be organized and operated exclusively for charitable, educational, scientific, etc. purposes. Over the years, however, the word exclusively has actually come to be some other words, more like primarily. And of course, the service hasn't created a bright line for that, so we can't say is primarily 80%, is it 85%. So the correct answer for that is true, because that's the way 501c3 reads, but in practice, there's a little more wiggle room. And wiggle room is a technical tax term. The next item we're going to look at is Private Letter Ruling 2008-32027. Again, this will be included in the email that you receive. This, although it is a private letter ruling, is a phenomenal discussion on this whole topic. So again, if you want to dig in on this, this is a great place to start. This is about a community foundation, and they saw a need to support the organizations in their community by providing grant-making support services, right, to teach other organizations how to have an efficient grant program, and for those that didn't want to have their own, that they would sort of do a back office grant program for them. So that was one of the things they wanted to do. And they were also going to provide what the IRS called administrative and clerical services. In the analysis, the IRS did indeed divide the 9 services that the Community Foundation was proposing into 3 categories. The grant-making support and training was one category, and then there was an administrative category and a clerical services category. So not surprisingly, the IRS held that the income received from the reasonable fees charged for providing the grant-making services would not constitute unrelated business income, and the income received from reasonable fees for the administrative and clerical services would be UBI. But what is really good about this private letter ruling was not so much the outcome, but the discussion. So all of the prior rulings and the regs are cited in this letter ruling, and you can really get your head around this whole topic with this PLR. So we'll make sure that we send that out to you. One thing I want to mention here, although in the PLR the IRS found that the administrative and clerical services were UBI, it's important to understand that the ruling does not stand for the proposition that all administrative services, by their nature, cannot contribute importantly to the accomplishment of an organization's tax-exempt purposes. Instead, the ruling simply stands for the proposition that administrative services are unrelated when they are provided to organizations whose mission is insufficiently similar to that of the service provider. So in order to really understand the significance of the ruling, then we have to look at what is the purpose of the organization providing the services. Okay? So I think it's important not to take a blanket rule away from this private letter ruling by saying, okay, admin services, you're out, because that's not what the letter ruling is saying. In PLR 901-2045, and I'm actually going to include this one in your information as well, because it's a ruling that I think helps to clarify the position of the previous letter ruling. In PLR 9012-045, the IRS held that the centralization and sharing of administrative services among organizations that share a related charitable purpose may contribute importantly to the accomplishment of each organization's tax-exempt purposes. Okay, what this is, let's say you have 7 organizations and they're all related, they have the same charitable purpose, but you've put the real estate in one, you've put janitorial in another, and various activities for legal reasons or for administrative reasons, whatever. And you have one that provides administrative services for all of them, right? You don't want to have 7 payrolls. So one company is doing all the payroll and they're doing all the benefits. That's going to be fine, according to this letter ruling. And it makes sense because if you took those 7 organizations and combined them into one, that one organization would have an administrative function. So it's not like you're trying to do an end around the UBI rules, which is what this is all about. This is service trying to prevent organizations from doing this end around the UBI rules. So I see that I've gone pretty long here. There's a couple slides on the treatment of taxable subsidiaries, just as a reminder, because we're seeing a lot of activities as organizations creatively find ways to generate revenue. So thank you very, very much. Debbie?
Thanks, Lynn. Go to my conclusions, Lynn. So I know Lynn didn't get to a couple of her slides, but again, we'll be posting them. So if you kind of look through and you have any questions on the topics, she will be available, and John will be available as well to answer any existing questions. So in conclusion, pretty quickly here, during the webinar, we've evaluated a recent IRS action on delinquent payroll taxes, identified the controversial short form 1023 easy application. We've reviewed the charitable contribution substantiation requirements and some pending legislation. We've discussed the FBAR requirements, and we reviewed Form 990 changes and other tax-exempt status updates. Again, if you've got any questions, please do submit them. And then I wanted to send out a quick reminder. We have started, there is one question here that's kind of come in, which is good. So we've got a couple of minutes. Question being, I don't know if we can answer this right off the top, but ASU 2013-06 is going into effect for some orgs soon and requires the valuing of shared services. I'm not sure really what the question is there other than that it's happening. Does that have something you're familiar with, John or Lynn?
Well, what that does is to focus people on what happens in the corporate world with advanced pricing arrangements, and that is fair market value services and consideration being exchanged so that it reflects properly on the books of the organization. That issue from a tax perspective stands there, but it does not impact the analytics that Lynn was good enough to take us through, which is apart from the values involved, however derived, and presumably in accordance with GAAP, for example, we still have the base issues about whether we are undertaking a certain activity and generating a revenue stream from a behavior that is ultimately related to our exempt mission, whether that's a behavior or conduct that we perform on our own, or whether we extend ourselves to support another organization. That becomes the critical issue for unrelated business income reporting purposes. The values then come in after you have answered the first question.
Thank you, John. And so just to wrap up, a quick reminder, you all should have received your invitation to our upcoming Nonprofit Symposium. It's our big annual event that we hold each year in San Francisco. John and Lynn will be there in person. So if you've enjoyed this, of course, come out and see them live. And that will be San Francisco, July 15th. There'll be a link. I can send that out with the follow-up as well. And with that, John and Lynn's contact information is on the slides. Thank you for joining us, and we hope you'll join us for a future Armino presentation. Thank you so much, and have a great day.